Hi, all. Thank you so much for joining us again today. We are live and back in action with the next episode of our For Purpose Entrepreneurship series. Today, we are we're really excited to welcome Zoe Schlag and Derek Razo to join Nargis and I in this ongoing conversation regarding purposeful entrepreneurship. Today, we will be specifically focusing on alternative funding and financing opportunities. We're hosting this conversation because we want you to know that there are a lot of options out there. And I think what's been most interesting to us as we've gone down this journey of exploration has been just the diversity of the field and the continued evolution of the work. So this is just a jumping off point. Zoe and Derek are experts and have been studying this field for a long time. And they hopefully will just whet your appetite for more information and more targeted deep dives to come. Nargis, love to pass it to you to share a little bit about your experience in this work.
Thank you, Casey. So exciting to be with everyone, all the Solver teams and our guests today. This is the 4th episode of our Purposeful Entrepreneurship series. Last time we discussed about ownership and governance. And today we are going to talk about a very related and very important topic of financing and capital strategy. I have been in your shoes. I have been on the road fundraising for a while for my companies and different efforts that I've been leading. And we usually hear this advice that go for smart money. So not all money is equal. You need the expertise and also the advice and engagement of your investors beside just the capital they're providing. But today we are taking it one level up, and we are saying not only you need smart money, but also you need mission-aligned money if you are a for-purpose entrepreneur. So as Casey said, there are many options today, and the world of finance and capital is evolving, and not all money is equal. And today we want to talk about different sources of capital for your company and how they are different in terms of the person who gives the money, how much control they want to influence, what expectation they have on the time to return or the size of the return of the investment, or what purpose they are pursuing with their investment. And you as an entrepreneur, with being more smart about your options and getting connected to different resources, you are going to have much higher chance of building a successful and mission-aligned business for the long run. So with that small introduction, let's start a conversation with our guest. We start with Derek Razo. Derek is joining us today from Purpose Ventures. He's an entrepreneur, investor, and facilitator with a passion for social change. He's co-founder and partner at Purpose Ventures, an investment firm and think tank which helps companies stay independent and mission-driven for the long run. Derek, welcome to our webinar today. Very excited to have you with us. Let's start by just learning a little bit about your personal journey to the world of impact investment and impact finance.
Yeah, thanks, Nargis. So I've got a little bit of a winding path that's led me here. I went to school in UC Berkeley and had this interesting experience of living in the Berkeley student co-ops and working in the sort of cooperative scene in Oakland Bay Area at the same time as studying computer science and business at Haas and kind of getting the more conventional business education for that area. I'll sort of skip all the transitionary steps, but eventually landed in New Zealand working with a group of social entrepreneurs called Inspiral. I was really focused around as like a shared ownership network for social entrepreneurs where like everybody would put in 5% of their company into a shared pool, and then we would there's 10 companies, we would all go off trying to do our thing, and the success of one company would mean the success of the other companies. And so it created this really interesting dynamic using shared ownership in a network structure. And that also led me to working on a couple cooperative and alternative mission-driven tech platforms. So the one that's most well-known, I think, is Lumio.org, which is a tool for online decision-making. Yeah, and that was that was sort of where I got my first exposure to a lot of the conversations that we now have all the time, which is like, how do you make credible promises to users that, you know, you are stewarding data that is going to potentially be dangerous if it gets out? How do you raise money in a context where you're trying to make credible promises about your mission and trying to make good on those promises? And then also, how do you structure an organization such that, you know, you can be confident that even when you're gone, or even when the team turns over, or even when the situation changes, it's still going to be mission driven. You're going to avoid that mission drift and values drift. So that was sort of where I cut my teeth on a lot of these questions. After that, I spent some time consulting with larger NGOs, kind of testing out the theory of change. Like, can you shift a large organization by, you know, 2 degrees and, you know, redirect hundreds of millions of dollars of capital that would otherwise go to something maybe less impactful? Ultimately decided that wasn't for me, just because I'm not, consulting just isn't quite my bucket of tea. We were helping them like set up new funding structures and all kinds of stuff like that, but it was just not that exciting. Yeah, and then I had this experience of really just like, sometimes I call it like a self-funded Fulbright. I traveled around the world and tried to meet people, communities, companies that were doing social impact work that seemed to be working. So I tried to figure out what is actually working in the global arena for creating change. I was in Barcelona the night that there was a vote to secede from Spain. I was in Mexico during a constitutional protest that was totally accidental. I ended up in a lot of experiences like that got me exposed to like how, you know, how much energy and desire there was for like deep structural change. And eventually that led me to stay a while in Germany, where I met my now partners in purpose.
Very cool. Such an interesting journey. I wonder if those events you mentioned were accidents, or you had a role in them. Let's talk about Purpose Ventures a little bit. Last time we were fortunate to have Camille with us, and she talked about the work that Purpose Economy does to help companies become steward owned and restructure to be employee owned. And you are on the other side of the house, it seems, working on the investment and making financial decisions. So tell us a little bit about how the fund is structured, what is purpose, how is it doing, how is it related to the steward ownership work, and how it comes together.
Yeah, so Purpose Ventures is a fund that's really dedicated towards helping companies move towards steward ownership. So if you're a company that wants to make a credible long-term promise to deliver on the mission that you've set out, and, you know, potentially include stakeholders, make sure that the rewards of the company's growth are shared with people who helped create that value beyond just investors, but also make sure that the company's profits are in the long term going towards its purpose primarily, then that's the type of company that Purpose Ventures is really interested in supporting. And, you know, we are interested in that not just from a intention perspective, you know, nice words on a website, but from a legal definition and codifying that into the actual DNA of the company. So that's really the thesis. And we've been seeing, just this tremendous amount of interest, and you know, more and more people, I think, are seeing that companies are these powerful players in the economy. Corporate structure is this really powerful force that decides what companies can and can't do in the long term, both at the micro and the macro level, local economies and the large scale economy. And more and more people, I think, are trying to ask this question that we ask ourselves, which is, you know, who benefits from and who controls assets in the economy, and how can we reprogram the default ownership, governance, and financing of companies, especially social good companies, to actually allow them to deliver on these promises that they make to their users and to society.
Very, very cool. So it's very related. You make decisions not only based on the intention of the founders, but their willingness to structure their companies in a way that the purpose is really ingrained in the operation and the governance of the company.
Yeah, and I would say that's like a first gate.
That's
Right.
an interesting on the gate question. I'm curious about how you think about accountability, right? Is this in a negative sense, you could say this is accountability for founders to practice what they preach. I think that's not a charitable way of describing what we hope is an alignment of values. But I'm curious if there are, in addition to the structures, there are sort of accountability measures built in that ensure this carries on for a long time.
Yeah. I mean, when you transform the legal DNA of the company towards a steward ownership form, you obviously have to answer a lot of questions about, both who's in the driver's seat, but also how do you keep those people accountable such that, if they're driving off the road, you can pull it back onto the road. And, I don't have a really, I don't have like a boilerplate answer for that. It really depends on the company and the stage and stuff like that. These accountability mechanisms tend to be relatively conventional. They're like red lines in a contract, in a term sheet, or pieces in the articles that allow for a sort of high threshold of a vote that would allow you to change leadership or management or something like that. So these are things that you would kind of expect to see maybe in a more mid-sized venture deal, but because we're setting up these alternative structures a little bit earlier than maybe the previous generation that was doing it once they were large companies, you do need to kind of program that in a little bit earlier.
Yeah.
So I was wondering if we can take a step back and just talk about the big picture, Derek. Like, you have been through many experiences, you've traveled around the world. So tell us, what are the options you see an entrepreneur has today? Most of the entrepreneurs, especially if they are going after big problems or they need some technical, scientific innovations, they need to raise capital to cross the valley of death. So what are the options in front of them in terms of sources of finance, the structure of the deals? How can they think long-term about their capital strategy? Because probably they need to raise multiple rounds as well.
Yeah, so let me step back just even one more step and just talk about a little bit of the work that we do in the US that is sort of alongside the investing work. So we've supported a couple dozen companies, if not a little bit more, who are early stage. A lot of the work that we've done has been setting up these alternative exits or growth rounds for mid-sized companies that are they're in a different place, right? They can raise a different type of capital. There's more availability at that stage. We're usually doing like liquidity for founders and stakeholders, as well as doing, so it's like a partial exit or a full exit into one of these steward ownership forms. When we go further back in the company biography, and we're talking about early stage companies, we've done a lot of support work with companies in addition to investing, where we will support a company to raise alternative capital, even if they're not ready to go the whole way towards steward ownership. We'll help them like set themselves up to have a long-term mission-driven ownership, governance, and finance structure. And so that's been a big part of the work that we've done here, and it has led us to kind of really need to build out a toolkit and a framework and a mindset training almost for folks that we found has been relatively successful in terms of helping people raise alternative capital and just reason about alternative capital. And the reason that we've done that is not because it's not for nothing. We found that once you step off of the sort of conventional path, which in this case we'll talk about it as like VC as the conventional path, which is raise multiple rounds and you kind of raise so that you can get to the next raise, and it's really focused on valuation and markup over time, which is all fine, but it's just dilution. It's a very particular path, right? And we can I'll skip it, but we could talk about what the outcomes of that, which we think are net negative for founders and for communities and people who are trying to actually build mission-driven institutions. As soon as you step off that path, it is just this like open universe of questions. Who do I talk to? What even are the other structures? Like, is my company a fit? How do I even think about, an exit if I'm not doing the conventional path? How do I think about, an exit in a responsible way that is going to allow me to take care of my family, but also like sets this company up for the long term? These are all questions that, my time at UC Berkeley, Haas entrepreneurship classes never touched on a single one of these questions, So it's really like a gap in the entrepreneurship training. so that just to like name that as kind of the groundwork, what we found to be really helpful is, and I'll just give like a little overview and we could dig into specifics if people want. We found really helpful is we really encourage people to first get internal alignment in the team. And I know it sounds like a little kitschy. It's like, yeah, get internal alignment among your founding team, but it is work that I think a lot of people actually skip often. Having the hard conversations about economics. What do you need to feel comfortable? How much money do you want to make? You don't need to make those decisions and put them in binding contracts just yet, but understanding where you are on alignment versus misalignment with your founding team is really important, because some paths will lead you towards higher risk and higher reward, and some paths will lead you towards lower risk and lower reward but more mission drive, and maybe you can carve a path in the middle, and we've helped people do all of those, but it's really important to get alignment. Then we encourage people to like decide between, it's a little bit of a false dichotomy, but I think it's helpful to decide between, are you going to do a blitzscaling strategy, which is the sort of raise to the next raise, maybe user growth is your metric, maybe some other, maybe some non-financial metric, non-revenue or non-profit metric is your metric, or are you going to do, we call it like curve jumping, which is raise to the next plateau of the company's stability. So that means like profitability or, break even, or like being close enough that you can step back from fundraising and say, if I wanted to, I would never have to fundraise again. But if I want to grow much faster, I can go out and take my time to fundraise the right type of capital. And those two modes of operation they're not entirely mutually exclusive, but they're so different in the gesture and how they manifest in like running your company. We really encourage people to kind of make a decision, and it's a non-judgmental thing. You can choose to do blitzscaling. We have advice for folks that want to do that in terms of how to structure their rounds. But if you're going to do that, it's going to be much harder to do curve jumping and kind of take your time raising the right amount of capital and stuff like that.
I love this concept of curve jumping. That's very interesting. So if a purposeful founder wants to do that, they really want to build a good business, profitable business. They're not just going after valuations. So what are their options? Who are the investors who are going to back them, and what type of deals they are looking at, and what type of exit structures they're looking for?
Yeah, so we encourage folks to think about this idea of like, who is your coalition of unlikely allies? Because there is no sandhill road for alternative capital, right? You can't just like line up meetings with 100 VCs that all have their emails kind of floating around on Twitter. Not yet, hopefully soon. So what this means is you actually kind of have to, often in these deals when we've set them up, you have to piece together different types of institutions. So you have to find, what type of deal you want to do, and I'll more directly answer your question about the types of structures in a second, but you have to find what type of deal you want to do, or the field of deals that you're open to doing, and then you have to go and find 2 to 4 different like audience groups that are going to be open to that deal, and piece together your round from that. So that is often how we see it working. The most productive groups that we've engaged with in these deals are like boutique financing or financial advisory firms. So Natural Investing is an example, Renew, Rethink. There's like a bunch of these firms that are basically, they advise sort of high net worth, but not ultra high net worth folks, people with between 5 million, 50 million in their net worth, who really want to do good with their portfolio, who, maybe they're older or whatever. Turns out there's a lot of these people, and they've come into groups like that have come into a lot of our deals with some of the largest check sizes, because they just gather, 100K, 500K checks from people in their network. That's a type, just to give you an example, that's a type of investor that I think most impact founders don't even know exist, but they're out there. Family offices have been really powerful allies for what we're doing, and really see this like alternative ownership in finance as more and more as like a progressive thing and as a positive, rather than a like risky thing or a negative. Candide, for example, has been one of our closest allies, and we really appreciate the
very cool. I love that it is a founder-driven fundraising strategy versus sandhill road-driven type of strategy. And as part of the work we are doing with MIT Solve, hopefully we can aggregate and create a more of a resource library for folks to reach out. Maybe as my last question before we get to our next guest is talk about exit. You know, a typical entrepreneur, when they hear exit, they think about this big bang major liquidity event, either through like a big corporation buy your company or you go IPO. But we are seeing there are so many other ways to create liquidity and return for the founders and investors. So tell us a little bit about that, especially in the context of stakeholder capitalism and purposeful ventures.
Yeah, so the exit is in some ways tied to the fundraising, the capital form. So hopefully can answer two questions at once there. I'd say that what we're seeing most people go for right now, and investors and entrepreneurs, is either, you know, a conventional equity type of instrument with founder control really built in, and really honest conversations with, you know, more conventional investors saying like, look, this is not going to be your conventional exit. This is not going to be your conventional, you know, hypergrowth strategy. And here's what we're trying to do. Or we see folks going for something like a revenue share. So, you know, we'll see like the classic term is like a 3x plus like a kicker of some, you know, 1% of the company or something's valuation, which gets bought back from the investor over time. And so these are like, you know, 2 of maybe 20 examples that we've seen of alternative capital deals. So without going through all of those, I'll just share that those are kind of archetypes, right? One is kind of trying to play the game a little bit, but knowing that the key variables are founder control and economics and the ability to hopefully like restructure the company in the future. The other is kind of putting the work up front to find an alternative capital deal that pre-negotiates like what's the exit that you're looking for the investors. Then the concept that we introduce to folks when we're working with them often is this idea of a recapitalization, which is, you know, not a super technical term, but it is in truth how a lot of exits actually happen. And recapitalization is really simple. It means that once the company is, you know, maybe more mature, or the company is like in a more stable phase, you're able to actually piece together more conventional types of commercial capital, say debt, maybe mezzanine equity or these other forms, to restructure the company. And, you know, in our world, that means restructure the company into a long-term ownership form that actually locks in the mission, while giving the founder some liquidity, investors some liquidity, other stuff like that. And there's a million versions of how you can do a recapitalization. It doesn't have to be the whole company. It can be to a trust. It can be back to the founders. It can be to the management, to the employees. But that's really the tool that we're seeing people use instead of a sale or an IPO, because it tends to allow the founders a lot more control about what actually comes out of that process.
I can see that as part of that. You can also imagine exit to the employees. Yeah. So that totally. Restructure can happen also. The employees become kind of shareholders or even investors. So that can contribute to the exit amount as well.
Yeah, employees and community, and, you know, maybe more aligned investors or people who are willing to take a dividend rather than a, you know, big bang exit. Like, these are all options that you get as the company moves forward and matures. And again, this is the difference between the like blitzscaling and curve jumping, because in the curve jumping strategy, you can kind of take your time and say, okay, who do we want to be on the cap table in this next phase of what the company's ownership is going to look like? And that can be a lot harder to do if you're, you know, if you're really racing to the moon. So, yeah.
I have so many more questions, but I know we only have an hour. So back to you, Casey.
Awesome. Thank you so much. Thank you, Derek, and thank you, Nargis. And I am so excited to introduce Zoe Schlag, who is currently entrepreneur in residence at Schmidt Futures, and she'll tell you about what she's working on that's something new. Previously, Zoe served as managing director at TechStars Impact, TechStars' first impact fund, where she invested in 75 companies using technologies to solve pressing social and environmental problems. And Zoe also founded and served as CEO of Unlimited USA, an impact organization, which she led to join forces with TechStars. So I am really excited to bring Zoe on screen, and then eventually to have Derek come back and have you guys talk to each other, because you have a pretty remarkable impact story, particularly focused on this funding and financing world of marrying sort of traditional systems with some new thinking. So I would love if you could start, Zoe, by just sharing your story and sort of how you found your way from founding your own nonprofit to working with TechStars and sort of where you are now.
Sure, thank you. Thanks for having me. I'm really excited to be here. Like Derek, I think my path here was a little bit winding and I never actually really intended to end up in the impact investing space. Just quickly, so I actually got my start in the world of international development. I studied international relations, security, and post-conflict societies in school. So when I was in college, I spent some time in Guatemala on a coffee farm of ex-guerrilla fighters who exchanged their weapons for land, pulled it into a cooperative to sell it to the fair trade market.
So you're just jealous that Derek saw some social unrest. That should have been you.
Indeed.
He took the wind out of your sails.
Indeed, totally. Let's see, after school, I went down to Argentina. I spent some time down there working with a nonprofit organization, working with child laborers and their families. While I was working with that organization, I helped them build an internal social venture to bring more income generation to the mothers of these children so they could not need their kids to be working. And that was kind of my entry point into thinking about entrepreneurship as a lever for change when it comes to issues like wealth inequality. So that led me non-directly to India, where I spent about 2 years working with an organization investing in early stage impact founders. And that's really where I fell in love with working with founders. I was having so much fun with it and was really interested in the model. So after about 2 years there, I ended up moving back to the US. And like you mentioned, Casey founded an organization, Unlimited USA, which was an impact investment organization. We were charitably funded, investing in both for-profit and nonprofit social ventures, modeled off of Unlimited India, which was the organization I was working for in Mumbai. We built that, grew that organization over the course of 3 years. Again, raising all of our money charitably. So when, as we were heading into year 3, we're thinking about what is our long-term theory of change? What is our long-term business model? I had some support from our existing funders to go out and raise a small fund, in the $20 to $25 million range in Central Texas. At that point, the questions I was asking myself around theory of change was, how can we catalyze more capital to move into impact companies? So a small fund would be great in terms of the direct investments we do, but would never affect things on a systems level. So I wasn't actually excited about that path, and instead looked to TechStars, which is a global accelerator organization and venture capital firm. At that point, TechStars companies were 5% of all US Series A deals, which is just an insane amount of market share. Yeah. And I had a great relationship with them, with several of their managing directors, their chief investment officer, and looking at that organization and the pace that they were growing, I basically thought, this is going to become the most active seed stage investor in the world. If we're really approaching this from a systems level, how can we help bring them into the impact world? So we essentially joined forces, my organization, with TechStars to spin up their first impact program. We launched TechStars Impact in 2017, I think. And so I ran their first accelerator program. We also invested in impact companies across the ecosystem, seed and Series A deals. And since then, TechStars has really scaled up its impact work. They have an accelerator program with the Nature Conservancy focused on sustainability, a workforce development accelerator in Colorado, another impact program in Atlanta, and a longevity program in DC. So they've really scaled up their work, which was really exciting for me to see. And throughout that phase, I felt myself kind of stalked by this existential dilemma that I just decided to ignore as long as I possibly could, which was this. I felt like as an early stage investor in impact companies, I was seeing great opportunities as impact investments. They strong impact products, real financial return potential, really strong alignment between the impact model and the business model, so that there wouldn't be, a huge amount of tension as they're scaling the business model between business and impact. And yet, I was too afraid to answer the question, if we succeed in scaling these impact products, given who sits on the cap table, will we make wealth inequality better or worse? You can see why I tried to ignore answering that question for as long as possible, because you don't have to look at it too long to realize, yes, this is a complicated problem, but ownership is actually one of the really important levers for change and impact that I think we haven't paid enough attention to. I think over the last decade, the impact investing world has done a really good job of turning towards technology for solutions. And that's because technology scales. And yet product innovation is only one lever for change for impact that sits alongside financing, which sits alongside governance. So that kind of sent me down a bit of a rabbit hole over the last year, just exploring issues around ownership, governance, tax policy, basically all of the least sexy parts of impact investing that I find the most fascinating, which is why I'm super excited for this conversation. And I think what that points to is my current impact thesis that I'm focused on, which is, if you look at wealth inequality in the United States, I'm sure the folks on this webinar know this very well, but it's bad and getting much worse. Over the last 5 decades, worker wages have stagnated or declined, even as the stock market and economy has grown. And that's because of the asset divide. Put simply, it is a complex problem, but one of the aspects of this is that the way to build wealth in America is through ownership, not wages. And the majority of working Americans are locked out of opportunities to build wealth through ownership. So that is kind of the current ecosystem and area I am playing in, and has been an evolution through thinking about business models for social change, to scalable technology products for social change, to financing and catalyzing more capital to help these companies grow, to now thinking about issues of ownership and control, and who participates in economic upside, who decides, who makes the decisions within these companies.
That's an incredible summary of a deeply experienced journey. Nargis is giving you a round of applause, which is really nice. I am so curious how your experience as a founder impacted your experience as an investor, and where there's crossover, and did that accelerate your path towards exploring these alternative governance structures?
That's a great question. One, when I coach founders on fundraising, I always encourage them to consider raising from founders turned investors. And that's specifically because I think founder investors have a unique understanding of the journey of building a business. And I think they will be some of the most helpful investors on your cap table. I think a lot of what it taught me about early on is the importance of who is funding your venture. When I was running a nonprofit, it was charitably funded. So I had that experience. With the fund I raised with TechStars, we had a really wide range of LPs, everyone from big banks to commercial venture capital firms to impact venture capital firms to family offices, angels, and philanthropic foundations doing MRIs. So it was an incredibly wide range in terms of the types of LPs that we brought in. And I think, we had strong alignment, which I'm really grateful for, but it's really pushed me. The different conversations I had with those LPs throughout the process has really pushed me to think about this more critically in a way that I don't think I would. And it has also pushed me as an investor in my companies to really prompt them to think about, who do you want on your cap table, and what kind of control are you willing to give them?
Yeah, it's funny because Derek mentioned specifically, focusing on transitioning the structures themselves, and your work at TechStars was about working within existing or call them traditional seed and Series A structures, and sort of aligning the back end, call it, in terms of who's on the cap table and sort of what control they have. Has your perspective shifted at all about either, are there certain companies that are just better for transitioning structures versus working in existing structures? Or do you think that there's a continuum and that a founder's preference could actually drive some of the choices that they make along?
It's a really good question. Insofar as we're talking about impact technology for-profit companies,
yep.
I think the realm of investors that are easily apparent and obvious tend to be just commercial VC. So a lot of the founders that I've worked with have raised primarily from commercial venture capitalists. Some of them have raised impact VC, and some of them have raised from foundations. I think the challenge that founders will face is the more capital you bring on, the more equity you raise, and the more that equity comes from commercial VCs, they are expecting a commercial return. And that is their fiduciary obligation to push for that. And so it can be much harder to convert once you have raised significant equity from commercial investors, because at that point, assuming they have a board seat or some kind of control in your company, even if you lined up investors to buy them out, it probably wouldn't be at the level that they would approve the deal, because they need such a large deal. Now that can vary. There's no hard and fast rules, but I think typically it is easier to set up these structures earlier on in your company's life cycle as a scalable tech for-profit company, as opposed to later on. And I think beyond that, it really puts a flag in the ground for you as a company very early on around your company identity, and will attract more funders to you. It is possibly a harder path to go down because these funders are there, but they are not as easily apparent as, the VC investors who show up to demo days or whatnot. But I think it's well worth the time to really find these aligned investors who don't just talk about alignment, because talk is honestly just that. There's also the structural aspect.
Yeah, and within the structural aspect, I'd love if you could give us a little bit.
Casey cut out for me, so.
Oh, Casey's back.
Yeah, there we go. Sorry about that. I was just going to say, can you talk a little bit more about what you're doing now and how you're layering governance into some of these conversations? Because I think that thinking about those tweaks on the margin is really interesting and applicable to the work that our founders are doing.
Sure. So I'm currently an entrepreneur in residence at Schmidt Futures, which is a 2-year role with them, which is, it's a really interesting role. I'm spending a portion of my time working on my own venture and scaling that up, and then a portion of my time supporting their team internally on grant making and impact investments. One of the things that I don't think enough founders pay attention to is the why now factor. Granted, there's always need, but I think you need, as a founder, a strong thesis or articulation of why is now the right time for this particular solution to take off. And what I'm focused on is really a why now solution, which is the Silver Tsunami, which is a hilarious name, but what that refers to is the wave of boomer-owned small businesses who are going to be looking to retire over the next decade. Just quickly to calibrate on stats, it's 10 trillion in assets that's going to be sold or passed down over the next 20 years. And 3 in 5 small businesses are going to look to sell in the next 10 years alone. So what we know here is that this is a wave of transactions that will happen. The demand for some kind of exit opportunity is a known quantity. And if we in the impact sector can supply the platforms, support, infrastructure, and capital, we actually have what I consider is a once in a generation opportunity to course correct on one aspect of wealth inequality by converting these small businesses into employee ownership. There's a lot of folks working on this because it is such a huge impact opportunity and a huge market opportunity. But I think, if you look at the potential of what funds and platforms can do to convert small businesses to employee ownership over the next decade, it is astronomical and would fundamentally retool the underlying economics of an entire segment of our economy.
No big deal.
We have this major opportunity right now. And I think so many people should be working in this space, because the other thing is this is a wave that we know is going to hit, and it will pass. And so I think it is incumbent upon the impact sector to really ramp up as quickly as we can, because this it really is a once in a generation opportunity.
Yeah. And can you give us just an example before we bring Derek back and have you guys chat a little bit with each other, but can you give us an example either on the investor side of an opportunity, whether it was you or someone that you worked with who really worked with a company to employ some new strategies around ownership and governance, or on a team side, a company you've run into who's really actively pursued some of these strategies, and who's done it well?
Yeah, it's a good question. Honestly, this is an area where I'm learning quite a bit from Derek. I would say my experience with in early stage impact investing, the folks who I've seen do this the best are will set up some kind of governance aspect that's usually tied to the founder. So, you know, they have a certain amount of voting shares or a golden share voting right that the founder has that limits a certain amount of risk in terms of protecting mission, but it's not a perfect solution. CEOs can get fired, it happens. And also the CEO may have a different decision rather than protecting mission. Hopefully that's not the case, but that is a risk level that sits there, which is what got me so excited about the work that Derek and Purpose is doing, because it really retools the company DNA to protect purpose. I will say, I can certainly talk about companies that have done this well. I think the more interesting examples are companies who have done this really, really poorly. And I will say the areas where I see founders most misaligned is when you're pitching upside for your company. If an investor is on board with you, like everyone is excited about the upside, and what they miss is really exploring the downside. If things don't go according to plan, how are we going to handle it? It is an investor's job to think about that. So I guarantee you they will know how to put those in the docs and put clauses in the docs that protect them and their downside. It's not your full-time job as a founder to know all of the tricks of the trade that investors have developed. And I think, unfortunately, the strategy that I see most founders employing to protect their governance and their mission with their company is hope. Yeah. And hope is not a strategy.
Yeah. But it is a muscle. I think that's right.
It is a muscle. It is a muscle.
Amazing. So let's bring Derek back. And I'd love to ask both of you, because you spoke to this, and there may not be a great answer, but you both talked about the importance of finding investors that have alignment. How on earth do founders go about not only finding those, Derek, in the woods, in the big morass or gap of information, but also too, then how do you vet? How can you really look into someone's heart and have an understanding of both the sort of business acumen and intent to really put that group together?
Yeah, this is sort of the $10 million question in some ways. I can tell you how we've seen people be successful at it. I don't think that we've cracked the nut on like what's the most efficient and effective way to do it. I think that, you know, some kind of maybe digital equivalent of Sand Hill Road like is actually needed for these types of deals, which maybe is a different session. But so what we've seen people be successful with is, you know, basically word of mouth. So using the fundraise as an opportunity to find their way through these networks. I think that if you've been in the impact space for a while, you know some of the players, you know, and going from exploring both the industry specific people who are focused on, you know, deep impact or structural impact. So if you're in food and agriculture, there's like, you know, tons of these firms that have really flexible capital. And so it's partially about knowing what their structure is, right? Like these financial advisory firms can do any type of deal they want. A DAF fund, as I understand, like MIT has, can do any kind of deal at once. There is a certain type of structure that you have to understand that the investor has that will even allow them to consider the type of thing you want to do. And then from there, those people often know other people who are doing similar stuff, because it's a really small world of folks who are kind of experimenting with these structures. The challenge has been historically, I think, at least in the last like 5 years, there's a lot of networks for these types of things, but they're all investors talking to investors. And so it's like, you might have the alternative capital summit, but it's like, it's primarily actually investors talking to other investors about the structures that they're experimenting with. And it's kind of not disseminating as much towards entrepreneurs. So we started this alternative capital accelerator partially because we wanted to bring that knowledge from the work that we've done as investors and as investment advisors into the space of entrepreneurship, because there is no like easy answer. I would say that like crawling through these networks and touching on people who have done it as well. So like finding other people who have done alternative capital deals and asking them has been really successful for a lot of the founders that we've worked with. And last thing I would say is I think Zoe's dead on with like finding investors who have a structure behind them that is not a conventional institution is really, it's hard to do, but it's really successful in these deals. And one of the major sources are people who used to be founders or who are like now exited founders who, you know, they know how the system works just as well as the investors do, and they're actually able to potentially support you through that process, saying, look, I still want a good return, but I also, as a previous founder, want you to retain control and want to support you in that mission. And so the more that you can raise from individuals who have that, now I think there's like a whole trend of like micro VCs and stuff like that. Like those are structures that I think are more and more amenable to this type of thing. And then finally, there's a bunch of services. So there's like intro.me, which will help you find like A&R financing and all kinds of other sort of like short-term financing options. There's pipe.com, which is kind of complicated tool for advancing subscription-based revenue. There's like Clearbank and Lighter Capital and all kinds of firms that like in particular will do revenue-based financing for companies that are scaling. And those are really commercial, really clear cut. They have a clear system for how you qualify, how you don't qualify, and they can move really quickly. So
that's so cool. Thank you, Derek. I want to also ask the same question from this other perspective of the mainstream investors out there, building on the theme Zoe was talking about of changing the system and going after really large scale impact. And you were talking about hundreds of thousands of small businesses that we can transform through changing their ownership. And you also talked about why now. We are living in a moment that there is much more attention now to actually wealth inequality, and also attention to pressing problems such as pandemic or climate change, where addressing those do not necessarily, land into this model of the blitz scaling and like short exits, and needs much more patient capital, long-term thinking, and employee ownership. So they say never waste a crisis. We are in this critical point in time, and the typical VCs that go after short-term, exits and standard deals, there are people like us. They have LPs, they have investors who care about these causes, I'm sure, but they're all kind of in the system because that's how we do things. That's the status quo. So my question for you is that what would you tell the mainstream VCs, because they are controlling most of the capital for early stage ventures, whether we want it or not. How can we start evolving that model to become more patient, more purpose driven? They are scared of losing control, I imagine. Yeah, and they also have to respond to their LPs and investors who want return in a certain amount of time. So how do you think we can hope this work that you and others are doing, which is kind of now still on the margins, become actually more and more mainstream, the way businesses work? Because we believe that should be the future of business. Actually, these are better businesses for not only the founders, but also investors and the world.
We can really peel back the layers of the global financial system on this one. I'll start with a couple of thoughts. So one, I think more and more people are really starting to realize the existential threat of some of our current challenges and how they will actually come back and affect them and their businesses and their funds in their lifetime. Things like climate change, wealth inequality. I mean, I'm pretty sure a smarter researcher than me could probably find some empirical data to back this up, but I'm fairly certain you could draw a direct line from rising wealth inequality and a Gini coefficient to democratic erosion, which affects all of us. Increasingly, these threats, they also represent existential level threats to people's businesses. So climate change is hugely going to affect global corporates' supply chains, for instance. So I think there's increasingly an awareness that was not there that really was on the margins 10 years ago, such that, I talked to one commercial VC who a couple weeks ago who predicted that every major VC would have a climate or sustainability focused partner on their team within the next decade. That said, the economic parameters of a VC fund are still the same. Even if they have a climate focused partner, what that means is they'll be sourcing more deals, but the same economic requirements still exist. So I think this is a moment where there is really high awareness of how these existential problems are going to affect all of us. It's not isolated. For folks in California, you can't just insulate yourself from the wildfires that are happening here, that if it affects all of us. So the more I think founders are driving the conversation with their mission, I think it's going to come as a relief to people, because people want solutions right now. They want a way to participate. I've seen this in so many conversations. And I think as a founder, and this was the same for me, fundraising is really, really hard. If it feels hard, that doesn't necessarily mean that you're doing it wrong. It feels hard because it's hard. And so it's really easy to just say yes to the first capital that comes in. But I think the more that you can really be willing to take control and just know that it's going to be hard as you go through the process, people are looking for solutions, and you guys are the ones who are building the answers.
I love that. All the power back to the founders.
I also like the idea that we can start to peel back the layers of the global financial system. I really like that too. So I guess while we wait to see, again, folks on the phone, feel free to send questions along to us. I'm always curious, and Zoe, maybe this is picking up on your point on it's an investor's job to know the downside. I'm curious where this breaks down. Like, when is this not a good fit for founders? And would love to hear your perspective.
When would what break down for founders?
When would alternative structures not work for a founder? Or it goes a little bit about when the structures themselves weren't implemented well.
Sure. Well, so the thing that all founders should be thinking about is, what is the financing life cycle of this company, and where do I want to see this go? It's unbelievably a conversation that so few founders have up front. I mean, I have a friend who bootstrapped his company with his co-founder. They split the company 50-50. They got an offer to buy the company for 40 million, but hadn't talked about what they wanted from the company, disagreed, and the offer walked away. It's a bootstrapped company. So one, like, have the conversation early with your founders, but I think where it breaks down is really, what is the financing necessary to scale your company? If you are the type of company that is going to be growing off of user growth and really need to subsidize the first couple of years before you see any revenue in the door, at this point, Derek, you may disagree with me, but I'm not confident that there's sufficient alternative capital to subsidize 5 years of user growth without revenue until you're able to monetize this golden land data set that everyone seems to be pushing towards. As a side note, I feel like every pitch I've seen over the last couple of years is, here's our 3-year roadmap to this proprietary data set. And once we have this proprietary data set, we'll have the keys to the kingdom. So if you're in that position, equity is really what you're going to need. And I think there are ways to protect control, be that a golden share voting right or otherwise. But to the extent that you can find capital that does not dilute you, such as revenue-based financing, I think that's a really exciting opportunity for founders.
Yep, I agree. I think that if your strategy is explicitly to not make money for a long time, this stuff is hard, because a lot of the alternative financing vehicles are, the trade-off is, we'll take a different type of return, a different type of exit for a different type of deal, like a different type of risk usually. And so the thesis about the risk has to be believable. And it's very hard to believe a thesis about lowered risk if your pitch is, well, we're just going to accrue users and data for 3 to 5 years, and then we'll figure it out. So I think that's a situation where it doesn't fit. I will say, I think that more people believe they're in that position, in my experience, than actually are. There is this like, depends on who you talk to, but there can be this tendency to like de-emphasize revenue and especially profitability in all of these spaces, impact investing and VC included. And I think that it's a little bit of a failure. It's often, in my experience, which is limited, but it's often in my experience a little bit of a failure of imagination more than it is like a failure of the tools. Because it's like, if you can't make money in the first 5 years, then that there's something is happening there that you should really like reinvestigate, because money, bringing in revenue and being able to scale revenue and increase it over time is such a powerful, having been an entrepreneur myself and like worked on these companies, it's such a powerful signal about what you're doing that is like really creating value or not creating value, that it's like, it's hard for me to believe a lot of these, and I've seen a similar trend, Zoe, in these pitch decks, but it's really hard to buy them, because part of it is like, it is predicated only on, you'll get this data set and then functionally it's like, you'll exit, right? You'll sell it to somebody who can actually monetize that data, or you'll need to raise this huge amount of capital to build a new team to monetize that data. And I don't know, it's such a moonshot type of operation that is missing the feedback loop of like, even like lean startup, right? Is like advocates for these feedback loops. And I feel like to give up revenue and profit as a feedback loop is that's a big choice that founders, I don't think, should just make without thinking it through.
Yeah, really interesting. And really interesting how that applies across both mission-driven and sort of traditional entities as well. I think my last question for you all, and Nargis, feel free to jump in, but I would love to know what you're most excited about in the space. Obviously, what you're both working on is cutting edge and sort of pioneering, but I'm curious if it's cool if you're really psyched about what you're doing, especially Zoe, working on something brand new, but would love to just hear what you guys are excited about in the space.
I mean, I can start. I think much of what I'm excited about is exactly what I'm working on, which is exactly the place that any founder should be. So if that's not the case for you, maybe reconsider and pivot. But what I would say is, while I'm specifically focused on employee ownership, that is one form of shared ownership that exists. And I think we're sitting at this precipice where new economic models are really possible. So for instance, labor marketplaces that exist right now, that feels like a really interesting place to me to innovate around how can we share economic upside. If you have a ton of 1099 workers on your labor marketplace who are driving the value of your company, I think there can actually be business benefits if you economically incentivize them with upside. So I could imagine creating share pools for these types of companies for their 1099 workers, fractional home ownership, ways for communities to be investing in their local ecosystems. I think, whereas I look at the last decade as like an area where we've really innovated on technology, I think we are at a moment where there's both the public appetite and innovators to innovate on capital structures, on ownership models and new economic models that allow us to think about the cap table as a lever for change.
Yeah, and I agree again. I think that, we run this fellowship, which is really focused on community projects that are doing alternative ownership, governance, and finance. And we run this alternative capital accelerator, which is focused on entrepreneurs raising capital. And I'm wildly excited to be watching this Cambrian explosion of experiments. Like steward ownership and alternative finance are these they're fields of solutions that can be customized and changed in all these ways. And I feel like more and more people are going out and saying, cool, I'm going to do the experiment in this way, and I'm going to go find capital in these new places, and I'm going to put it all together into this really compelling vehicle. And, people are being successful. Like, we are seeing a lot of our entrepreneurs succeed at raising money and transforming economic structures in their local communities and building companies. And that was less true, I think, 4 years ago than it is now. So I'm just excited to be in the ring with people. Like, I think that we're seeing this explosion of new experiments, and it's not clear to me exactly which will be the best and which will work out, most favorably. But I think that the fact that it's happening is just huge and really powerful.
Very powerful note to end our webinar today on it. Thank you so much, everyone. It was so exciting, so much information. I'm going to listen to it again very soon. Just write down all the good advice you had for the founders and investors.
And I would just add my thanks. It was so wonderful to speak with you both this morning, and we're looking forward to more conversation. Have a wonderful afternoon, and thanks again.